morning, everyone. Welcome to this deep dive into EIF processes. We're finally opening the black box of EIF to show you that there is not rocket science, actually, the way we analyze funds. But before we open the black box, I'd like to say a couple of words why we're here. We have seen that the statistics are pretty bad. There is no gender balance in the VC and private equity industry. InvestEU and the European Commission have actually set an objective for EIF to improve that situation. But we're also here because we're all human beings. We are sons, we are fathers, we are partners. And actually from a private perspective, I'm a father of 3 kids, a boy 16 years old and 2 daughters, 6 and 3. And looking at the statistics, looking at this situation, not only from a VC perspective, I'm pretty concerned about the future that we would be leaving to them. So there is also, for all of us, a very personal driver to invest energy and time to improve the situation. My daughters are still pretty young, and I hope that in 15, 20 years' time, when they will come to the marketplace, the situation will have been changed. So that's a token, personal token, that we're bringing into the situation. So as you said, today we'll make a deep dive. We'll present first a bit some high-level figures and information about our activity in VC, private equity, and private debt. Then we'll give you an overview of the investment process of EIF, and finally a deep dive into the EIF investment process. And finally, we'll share with you a couple of tips that we wanted to convey to you, especially for the first-time team, first-time funds, emerging fund managers. Cindy, the floor is yours.
Yes, I will start, but I will go on the stand. Yeah. Is it working? Yeah. So first, some background information. So my colleagues already shared this information with you on the first session, but just to summarize, EIF is acting as a market developer, as a market catalyst, or as provider of market access to different fund managers. We have these roles depending on the mandate we invest in the fund. For market, when we are acting as a market developer, we invest in new teams, in new markets, in new segments. When we are investor as a catalyst, we do invest in funds with unrealized track record. That's what Elodie was saying just before. Fund 2, Fund 3, where there have been not many exits, and where EIF, as an institutional investor, can really take the time to dig deeper in the track record and extract the information to make a thorough analysis on the track record, which could be a bit more difficult for other investors to look at. And as market access provider, we do invest in funds with proven track record, funds and managers that we've backed for several years. So that's what you see on that slide. We've been investor in private equity and VC for more than 25 years. We've backed some of the bigger of the blue chip names. But when we backed them, they were starting their journey. And we continued that journey with them for all these years, as we are a long-standing investors, and as we, even, in terms of EIF team, I've been with EIF for a long time, are staying with EIF, so we'll stay your counterparts for, a journey that will last several fund generations. So looking really at our investment process. So it's a very, I would say, detailed process, which is always the same. So there's really little room to change that process. The first step is what we call first screening. So at first screening, it's really for us to understand your fund concept. So we receive the information from you, a pitch, we assess it on paper to understand really, what you want to do. If something is unclear to us, we ask questions, but it's really, on paper, on an email conversation. Following that screening, one of our team members, or several of them, make a recommendation to go or not go to the following step. The following step is what we call second screening. and it's to assess the investment readiness of your proposal. Typically, it's a 2 hours meeting. Can be physical, can be online, depends of your preference. And during that meetings, during these 2 hours, we will go over you on the main key topics and on the main aspects of your proposal. It will be quite interactive. We will ask questions, but when we need to know something, we will ask it. And that's really important, and that will be, during all the process. It's a conversation. So, and we will provide you feedback. So that's really the important thing for you to know. It's not just you do a presentation or you send us information. If something is unclear, if we need more info, we go back to you. And after the second screening, our team meets. We discuss during our team meeting to know if we want to go on due diligence or not. And on due diligence, that's really quite a thorough analysis of what you plan to do with your fund. So we spent 2 days with you in your office. We do travel, a team of 2 or 3 people, depending of the team, and we spend the time to go over all the key aspects of your proposal. And Patric and Priscilla will go over these key aspects later during the presentation. But it's really to stress test and verify what you've told us before, and to go in the details and to go further, to really dig deep into what you want to do. We do that. We do interviews with people in your network with whom you've worked, provided references. We look at your track record and value creation and strategy. So we look at all these aspects during the due diligence. For you to be able to prepare this due diligence and so that you know what to expect from us. We're not going just to say, okay, we're coming at your door that day, that time, and let you completely blank. What we do is we send you an agenda so that you know what topics we will cover. And before, we send you what we've got in this slide as a comprehensive DDQ. So when I say comprehensive, it's like between 5 and 10 pages of questions that we address to you. And it's really for you to be in the best position to answer our questions. So that's what we want to do. We want you to be able to answer our question. It's not, we do challenge you, but as I said, it's a journey, and we try to understand your proposal better and place you in the position to provide these best answers. We've also an ESG questionnaire, a tax questionnaire, so that, as we're not just focusing on the commercial due diligence, we're also looking at this aspect. This is something that is dealt with during the due diligence phase. Following due diligence, we continue our analysis. We look at, in details at the mandate fit, which mandate we can invest in your funds. That's the deal allocation process. We do discuss the proposal with the other EIF services, so risk management, compliance, legal service. We will have some opinion on the deal, and then we go to our board approval, and following board approval, we've got the right to enter into legal negotiation. And for us, legal negotiation is very important. So we need to make sure that the contract we have with you, that we will refer to, and that will be the contract for the next 10 years or so, meet, what we consider to be the best market practice and, our requirements and the mandate requirements. So this is quite a lengthy process. It takes a lot of time, lots of discussion, but as I said, it's just to start the journey ahead, so the monitoring phase. So we do that, and once, finished legal negotiation, we're all happy with the terms and conditions, then we can sign the deal and start monitoring the fund and be, still with you for the journey ahead. That looking at investment strategy, and then I can give to Patric.
I'll just spend a couple of seconds on the previous slide. We often receive the feedback from emerging fund managers, first-time teams, that this process might be intimidating, especially with the names we've put on the slide. You see Atomico and Norzone and Creandum and Sofinova, and you're raising your first-time team, first-time fund, and you say to yourself, oh my God, but I'm never as good as those players that EIF is very well known to be backing for years. Well, the message here is don't be afraid. Don't be afraid of sending your pitch, engaging with us, even if your pitch is not completely complete. We are not a private fund of fund investor. We are the EIF. We are a public organization. Our mission is to support the backbone of VC and private equity market. We've been doing that for 20, 25 years now. We have brought a number of fund managers who were no ones 20 years ago to blue chip status today because we have taken the risk of supporting them. So don't be afraid. It's an iterative process. We'll never tell or hide away from explaining to you why we don't believe in your proposal. Unlike a private investor, we will not tell you that this year we're investing in the US or we're investing in real estate or investing in Asia. We have been doing that job for the last 25 years. I don't know how long we'll be doing that, but at least for the next 10 years, we're around for VC private equity in Europe. So the reasons that we will be giving to you for not investing in your fund should be taken as a feedback. It takes two to tango. So we'll be explaining to you very openly and very directly why it doesn't work. If you're willing to take on board our feedback, then we can resume the process. Sometimes the screening process stops at first screening, at second screening, sometimes at due diligence, but you will always know why actually we have decided to discontinue the analysis of the invest proposal. And if you're ready to take on board the feedback based actually on our track record of 10 to 25 years, we will resume the discussions with you. Without further ado, let's open the black box of EIF. And the main point that we assess in an investment proposal, in the investment proposal that you will be sending to us, is the investment strategy. And what the investment strategy is basically the DNA of your fund. It's the unique selling proposal, is what sets you apart from any other players that would be investing in the same field as you are. So the advice that I give to notably to the new joiners joining the team of EIF is, well, look at the investment strategy first. Don't look at the whole marketing pitch that the fund managers are sending, because usually they're very well drafted. And if you start reading page 1 to the last page, we would give the money to everyone. We focus on the investment strategy, and afterwards we look at 3 supporting pillars that will be supporting the investment strategy. That's the team and track record, the market opportunity, and the fund parameters. And our job as an investor in a fund is nothing else to assess the logical links between the investment strategy and these 3 supporting pillars. We're looking at a symbiosis between those elements. So it is very rare, I don't think it happens, that we reject a fund because the track record is not good or because the market opportunity is not good. We reject typically funds because the links between these 4 elements, in our view, are too weak and not fully thought through or are not connecting logically. Now we have only 35 minutes left, and we'll go through all these bullet points. Of course, I will fall short to your expectations into the deep dive, but we have breakout sessions afterwards while you'll be able to ask more detailed questions to our team members. So let's go into this deep dive. As I said, we start as investors looking at fund managers, assessing the strategy. As I said earlier, what the strategy is. Well, very often when we ask the fund manager what their strategy is, they say, well, that they would be investing in early stage, so stage focus, into a certain geography and into certain sectors. We think that this is the destination. This is Rome. That's where you want to go, right? But how you get there is the strategy, is rather how you will bring value to the companies that you're getting, that you're targeting? How will you, what is the added value other than just deploying the capital that will be entrusted you with? What is the added value that you will be bringing to the companies that you're targeting? And how will you do that, knowing that there is a competitive landscape, maybe not, there is a challenging environment? So the point here is that we are looking at what is your genuine, unique selling proposal, what sets you apart, and why fund managers, entrepreneurs will come to you and not to another fund manager. So basically what we are looking at is your investment thesis. A quick tip here is conviction. I've said that there are actually 4 elements that we are assessing: the strategy, market opportunity, fund parameters, team, and track record. There is one point where we would never challenge you, is on the strategy. The strategy is your DNA, is your USP. You might be tempted actually to look at us and for a feedback on the strategy. Look at our 35 or 40 different investment programs in order to fine-tune your strategy so it better matches one of the investment programs of EIF. But then you will fail to convince us, because you will listen to us, but we are not the only investor in your fund. You will be talking to other LPs. Other LPs might provide you another feedback, and eventually at the end of this iterative process, you will be completely lost because you don't know what you're investing in anymore, and you will not know what is the rationale where you're investing because you have listened to too many stakeholders and too many potential investors. So there is one point where we will rarely challenge you, is on the investment strategy. That's the first important message if you get out of here. The message is the investment strategy is your DNA. Take ownership of it. This is your proprietary IP. Around that, as I said, one of the pillars and the most important pillar is the team. So how do we assess a team? There are many, many aspects underlying the team assessment. I'll try to cover some of them and give you some tips and examples. There was a question earlier about first-time team, first-time funds. I think most of the audience are thinking about setting up their own fund. Elodie has, I think, answered the question. I'll dig a bit more into that. Yes, we do invest in first-time team, first-time funds. But the most important point is that we will not take the risk to entrust a team who does not have together collectively a track record which is relevant for the investment strategy. We're not asking for the team to have a collective track record, because by definition this is a first-time team, first-time fund. They would be working together in a setup of a VC fund for the first time. But we are looking at partners, individual partners who would have at least a track record which is at least partially relevant for the investment strategy. And we'll also look at a certain experience of those partners working together. So it's a first-time team, first-time fund, but the main risk associated to emerging teams or first-time team, first-time fund is chemistry risk. So if we are facing a partnership of 3-4 fund managers, 4 partners who have never worked together, it will be difficult for us to take the risk to support that team because of the too high, actually, chemistry risk. So how do we assess a team? These are 10 underlying focal point for the diligence of EIF. I'll go through them one by one. The first one is that we would look at the background, the completeness and the complementarity of the background. So we're looking, as I said, at a collection of partners who together bring an experience which is relevant to the investment strategy. Sometimes we see proposals where the teams claim to have a lot of experience, but when we look at investment strategy, we say, yeah, that's a very nice experience, but you're aiming to do something completely different. So the experience, albeit long-standing, deep in certain domains, if it's not relevant to the investment strategy, we will tend to disregard it. We will look at a mix of, especially on the VC side, of a technical background and VC background. So an example here, it's better to talk about example to illustrate what we are doing. We have in the past assessed investment proposals of a fund or investing in a specific tech area. I don't want to mention them, and if I give too many details, you might guess what that is. But they were investing in a specific tech field in the Nordics. We like very much the background of the team members. They were ex-serial entrepreneurs and founders, but they didn't have any experience in managing a VC fund. And a VC fund is very, very typical setup, right? You have a limited amount of money, the one that you raise during your fundraising, and a limited amount of time to invest the companies, develop the companies, and exit the companies. Those constraints are super difficult to manage. So we said to the team, guys, we like very much your strategy. You have a fantastic background. You will add value to the entrepreneurs thanks to your serial entrepreneur experience, but you don't have any VC experience. So we advise you to bring on board at partner level somebody who has already evolved in an institutional setup. They took the feedback on board. They brought somebody who was working for another VC fund. That was, I'm talking about 14, 15 years ago. Today, this fund manager is one of the most successful fund manager on the ICT market in Europe, and we have invested in their fund number 2, 3, 4, and now we are looking at whether we could not, whether they still need us because they have been so successful that they will not need the support of EIF going forward. Second, aspect, investment scheme analysis. We are presented with a team of partners who are all bringing a certain specific contribution to the strategy and to the venture. We will analyze how that translates into the distribution of the carried interest and the ownership of the management company across the team members. If we are presented with a team of equal partners where everybody is bringing a so-called equal contribution, but we realize that one of the partners is taking the lion's share of the carried interest, or one of the partners is owning 90% of the management company, that will be a sign for us that there might be some team instability going further because, well, the fact is that then most of the team members and the partners would be working for a one-man show who is taking the lion's share of the incentive package. Reputation, that's another important, they're all important elements, but that's another feature that we'll be looking at. We will be looking at and assessing your reputation by contacting other VC funds, contacting entrepreneurs that you've backed in the past, contacting your former employers. So the tip here for you is let us know everything. Let us know not only about the successes that you've been through, but also let us know about your failures, about your potential conflict that you have had with other investors. Because if you don't let us know, we will know. We've been investing on the market for 25 years. We have more than 750 funds. We know the who's who, and at one moment or the other, we will find out the truth. And we prefer that actually you communicate the truth to us than us discovering what you have been doing in a more gray way, I would say. So let us know everything. Network, that's super important. The reason why entrepreneurs are coming, especially on the venture side, is not only to get the money, but it's because they are in an early stage phase of development and they are willing to access to build commercial partnership with corporates. They're looking at having the opinion of key opinion leaders, notably on the life sciences side. So when in our due diligence phase we assess an investment proposal, we talk to entrepreneurs, and the most regular feedback that we get from the entrepreneurs is that they have partnered with a fund manager because of their network. I'll give you here another example. On the life sciences side, we have interviewed an entrepreneur, serial entrepreneur called Silvano Spinelli in Italy. He has created multiple companies, I think three or four companies in different fields of life sciences, and always with one fund manager, Sofinova. So we asked, well, Silvano, why are you always going back to Sofinova? Why don't you go to other fund managers? And the reason he put forward, what he explained to us, is that when he gives a call to the Sofinova team, when he's thinking about setting up a new company, he knows that within the 72 hours, the Sofinova team will put him in touch with the worldwide key opinion leader in the field that he's trying to develop. And it's not just an introduction through LinkedIn that's easy done. It's a real introduction with this key opinion leader willing to spend some time with the entrepreneur, because it is Sofinova who has called that a key opinion leader. So the network that you have is an essential part. Fifth point, independency, investment decision process, ownership of the management company. We clearly prefer independent teams. When we assess your investment proposal, we'll be talking to you as partners of the fund, as founders of this new venture that you're building up. We will assess you, as it has been explained by Cindy, in the first screening, second screening, due diligence. We're spending all of our time together with you. So we would struggle to understand why in your investment decision process you would have some third-party stakeholders that we do not know and with whom we will not have an official relationship, third-party stakeholders who would have a say in your investment decision process. We have assessed your quality, not the quality of other potential sponsors or third-party stakeholders. If you set up a fund, we would expect that you own the management company and that you don't give away actually shares in your management company because somebody else is bringing 10 or 15, 20 million tickets to your fund. So you have really to own your story, own your venture. Now, this being said, the approach of EIF is not black and white. We do prefer independent teams and autonomous funds, but we have and we do invest in funds where part of the carried interest is paid to a potential sponsor. We do invest in funds where a share of the management company belongs to another entity, but we'll always assess whether this is fair and whether these third-party stakeholders are bringing an added value that actually we cannot bring, a certain level of expertise or a support in the fundraising. We can assess that, but clearly our preference is on independent teams. Next point, alignment. Yep.
If I may quickly jump in.
Sure. Please do.
Thank you.
Let's keep it interactive.
On the independence, just to complement, what is really important is that the investment team that works on the transaction and actually takes the decision and takes the responsibility. And that's especially important in the private debt context.
We're aligned. Alignment of interest, good bridge to the next point. So we, as an investor and Together investor, we would be providing you with 99% of the financing for your fund. We're entrusting you with our money. We expect you to deliver an outstanding financial performance. But things can go bad sometimes. Things can go sour and not according to the expectation. So we would be looking at ways, at means that in case our investment turns out to be painful for us, that you would share the pain with us, that we're not only the one who are losing the money, but that we have a certain level of alignment of interest. And here comes the concept of skin in the game. So we're expecting that the fund managers that we're backing will invest some of their own money into the fund. Now you will ask me how much, what is the expectation? In the past, the standard rule of the market was 1%. So the fund managers would provide 1% of the total fund size into the fund. Now the reality has actually become much more flexible. In certain cases, we have invested in funds where 0.5% of the total fund size was enough to ensure, to give us the conviction that we have an alignment of interest. In certain cases, 50 15-20% GP commitment would not be enough to provide a financial alignment of interest, because the fund managers who are managing the fund are actually very, very wealthy persons. If you look at, for instance, a fund like Atomico, which has been set up by Niklas Centrum, who has notably founded Skype, well, he could finance the funds that he's investing in on his own. So there, whether we ask a 10, 15, 20% GP commitment is becoming a bit irrelevant. The second important point is dedication. We are entrusting you with the money from European Commission, from EIB, EIF own resources to build a venture, and we expect that this will be your 100% professional career dedication. We will find it very difficult to accept that you would have other sources of income or other focus areas in terms of a professional career. So basically, we're expecting that you're 100% dedicated to managing the fund that we're investing in. Of course, the legacy fund, if you're raising your second, third fund, and the future funds. But if you are only spending 50% of your time managing our money, we'll find it difficult to come to a positive conclusion. Seventh point is stability turnover. That's for funds which are beyond, which are raising their second, third fund. We would look at the turnover in not only at partner level, but at lower level as well. That might be a sign that there is something which is not going very well in terms of team chemistry. We will actually ask the contact details of the partners, directors, principals who have left the fund. We will contact them and we'll listen to their story as well as to the story provided by the partners raising the successor fund. Succession issue, also more important for fund managers raising their third, fourth fund, depending on the age of the founding partners, but we are committing for a period of 10, 15, 20 years. So the partners who are in their 50s, 60s, yeah, it's I think quite natural that would be assessing how their succession will be ensured. And here a tip is think about it before you talk to investors. We had cases which were a bit awkward. I'll share one with you, and it's not a caricature. We have gone on a due diligence. The managing partner and the founder was 65 plus year old. So we have asked him about his succession plan, and then he told us that he gave us the name of one of the other partners. And then in the individual interviews that we ran during the due diligence, we interviewed this other partner who was supposed to be the successor, and we asked him the question, okay, what about the succession of the founding partner? He said, I don't know, but definitely not me. I'm not qualified for doing that. I say, guys, you could have had a little meeting together to accord your views and to align your views before you talk to an investor. So that's an important point. Apart from that anecdote, do spend time together in preparing actually the presentation to investors like EIF, because we will be testing it from different angles, and we are looking at a coherent outcome of that assessment. Workload analysis, rule of thumb is that we are expecting to see 5, 6 active companies per partner. That's the rule of thumb that we apply in looking at the workload analysis. Why 5, 6 is not us defining that. It's basically the feedback from the entrepreneurs. Once a VC partner has more than 6, 7 active companies, the feedback that we get is that the entrepreneur feel that such partner is not so active anymore, doesn't have so much time dedicated to the company. So basically it might impact the reputation, your reputation as a fund manager in the entrepreneurs community if you have too much workload, because you will not be able to respond to the expectations of the entrepreneurs. Of course, this is a rule of thumb. There are different models on the market. We have accelerator models, notably accelerator funds, where you have 90 companies built up during the investment period with 3, 4 partners. So we do know that this is a different model, and we will not apply this rule of thumb. I'm just giving here a superficial tip. And finally, we'll look at diversity and inclusion policy. That's part of our ESG questionnaire. And I think, Priscilla, you will be addressing that at a later stage. Track record. What is a track record? Basically, as I've said before, is the capabilities and experience of your composite team that needs to show a clear and dependable track record. So when we get a track record from fund managers, the first thing we do is not jumping and assessing the financial performance, whether it is good or not good. The first step we do is looking at the relevance of the track record. The track record, how relevant the track record is for the investment strategy that you're putting forward. And sometimes we get investment proposals of fund manager who are willing to invest in early stage startup, seed, pre-seed, but the majority of the experience of the team is in companies which are established, profitable with a turnover. Well, we think that maybe that's not the best experience you might have accumulated to talk to founders actually who do not have any sales and profit. So relevance is the key word. We're not expecting, especially for first-time team, first-time fund, a realized track record. Of course, if you have some exits that actually can illustrate your capability of generating returns on the proposed investment strategy, very good. But we would be looking at a certain form of validation. And what is the validation we're looking at? Well, notably, the quality of the investors in follow-on rounds. You might have been the first one investing in a pre-seed and a seed round, but if in your Series A round you have been able to attract blue chip VC investors, we would see that as a sign of the quality, a validation of the quality of your track record. As before, as I said, we have plenty of tools. I'll not get into that, but we have tools to analyze your track record. We will run reference calls. We will make sure that the track record you're presenting to us is indeed your track record. So we might even call an example. We had a first-time team, first-time fund in Poland. One of the partners was at, I think it's Deutsche Telekom Ventures in Silicon Valley. He showed us a track record. We say, well, that sounds pretty great, but how do we make sure that this is really your track record? Well, we have called his partners and his former employee in the US, and we have asked them what were the deals that this partner was responsible for during his tenure at the Deutsche Telekom in the US. So we will always looking at backing the information, making sure that what you're telling us is indeed the reality. I'm looking at the notes and making sure I haven't missed anything. Don't hesitate to come. Priscilla, please.
Just to quickly jump in, I think what you said is very important, especially for first-time teams, that we look for the combination of track records. So especially in the private debt space, which is not as an old asset class as the VC or private equity, where you probably won't have like 3-4 funds of track record. We really look, okay, what have the individuals done? Maybe also in the banking space or technical experience. What was the performance of the investments you did? In which sector or in which investment type do you go? Do you go more for senior? Do you do unitranche? Do you rather go for more junior to really understand, okay, what have you done in the past? What are the different team members' contribution? And then to see what were, for example, defaults on the past portfolio, on your investments, and how to combine this into the fund. And I think also another point Patric made, but just to also complement, is when we see that maybe some part of experience may be missing, we do indeed encourage you to maybe complement the team if and where needed.
And we will go as far as even providing you some names of potential partners and introduce you to people who might actually be a good fit. But of course, no commitment from your side to take those persons on board. But we might help you in this phase. So a track record. Main point is relevance. We will assess the current performance. Obviously, we'll do some benchmarking to assess whether your first, second, third, fourth quartile. We'll make an assessment on the final expected performance based on your projections about how the companies will evolve in the next 3 to 4 years until exit. And as I said, we'll make some reference call to previous employers, partners, portfolio companies, and so on. So again, please let us know everything. Tell us about your failures as well, not only about your successes, because in any case, during this process, we will find out everything about you, much more than what you think. And by the way, actually, this is something that is a regular feedback from the fund manager who go through the due diligence process of EIF, and Elodie has gotten that feedback zillions of times, is that the fund managers end up knowing much more about their business, their own business, than what they thought they knew before engaging with EIF. So we really push you in every corner in a way that actually you will understand much better what you have been setting up. Market opportunity, I'm trying to accelerate, I see the clock, the timer decreasing. Market opportunity, so what is it? Is basically the market that you will be tapping into. I see a lot of people taking pictures. Don't worry, we'll share the slides afterwards. The slides are available. No, we cannot say we're opening the black box and close the black box and not share that with you. So we'll share that with you. So we'll assess the market that you're investing into. We'll assess the competitive landscape. We've been investing for the last 25 years on the VC market, so we have our own data, we have our own expertise. How we assess that? Well, as I said, through our own track record, but also on the basis of your information. We do invest a lot in new markets, new segments, new industries in which we do not possess actually any expertise. We are relying on you actually for that expertise. So basically what we are expecting in these cases is that basically you know more than what is in the McKinsey report or the BCG report covering the field that you're investing in. We're really looking at you as the people who have the highest level of expertise in the targets that in the targeted sectors that you're investing in. Fund parameters, last but not least, a supporting pillar of the investment strategy. One of the most important one in that actually what is the fund parameters, as it says, is a bit the nuts and bolts of your fund. One important point when you raise your fund is that you're managing a fund and you are expected to deliver a performance on the fund level basis. So in other words, you can be very proud if you have companies which are being exited at 400 million, 500 million valuation. You might be very proud if you have a unicorn in your portfolio. That's all fine. You should be proud. But if you don't manage to leverage those successes into a return for your LPs, then we might have a discrepancy when you will raise your next fund. In other words, imagine that you have a fund which is 50 million euros. Your objective is not to return the 50 million euros. Your objective is to return 100 million euros, right? Especially in venture, the rule of thumb is that we're expecting at least 2 times return. So you raise 50 million, your investor expecting you to return 100 million euros. You invest in a company which turns out to be a unicorn, 1 billion euro, let's not say dollars, euro valuation. But at the time of the exit, you have 3% of that company. 3% of a unicorn is 30 million euros. So with your 50 million fund, you've managed to invest in a company which turns out to be a unicorn. You're not going to get more than 1, maybe 2 unicorns in your portfolio. But if you don't have a sufficient stake at the exit when you exit that company, you will fail to meet investors' expectation. And this is where the difficult story starts. We have fund managers going on the market, calling us and say, guys, have you seen I have a unicorn in my portfolio? I've been able to exit a company at 1 billion euro valuation. And we look at it and say, yeah, so what? So it's very important that you are conscious that you're not managing a collection of companies, but that you are managing a portfolio of companies where you have to maximize your exposure of the fund to the winning companies and pulling the plug earlier. So This is very easy said for us because we are an LP. It's much more difficult for you who are behind the steering wheel. I can go next to the slide. So this is why it's not, that's the slide. Thanks, Olivia. We will be asking you for a portfolio model. A portfolio model is a very theoretical exercise. It's an Excel sheet with the companies that you aim at investing in. So it basically is crystal ball reading. Company 1, 2, 3, 4, 5, ownership at entry, ownership at exit, the time of your first investment, how many companies will go bust, how many companies will be winners, when you will deploy the money, and when you expect the money to come back. This is a tool which typically fund managers do not like because it's very theoretical, but at least it gives us a common understanding, a common language about what you have in mind and what you think you should be taking on board and how you should actually integrate the constraints of a VC fund. Last point on the fund parameters, budget, super important. That allows us to assess the level of management fee. What should be the level of management fee? Well, there are different mechanisms on the market. The rule of thumb is that the management fee is around between 17 and 20% of your total fund size of the lifetime of the fund. How do we assess it? We ask for a budget. A budget is simply an Excel file. Again, on the top line, you have the different incomes of the different funds you're investing in, and then the expenses are the personal expenses, the admin expenses, the real estate expenses. And what we're looking for is that actually the management fee is not the main driver for setting up a fund. You shouldn't become rich on the management fee. You should become rich because you're generating carried interest. So we were looking at the bottom line and the profit which is accumulated over the years when analyzing a budget. I can skip that slide. We're running out of time. And yeah, sure.
Yeah. So on the budget and the portfolio model, this will be part of our DDQ that we send to you. So you will have the Excels to fill in.
Exactly, absolutely. So I see again many of you taking pictures. If you don't have a budget, we'll provide you with a template to give an indication. Again, it's not a absolute must-have to use our template, but it will give you the level of details that you're expecting. If you don't have a portfolio model, we'll also share that with you. So again, don't shy away of asking us questions if you don't understand during the investment process what exactly we're after. We'll provide you the information, the context, and the explanation. And finally, I think I'll leave the room and the floor to Priscilla. As I said, we are committing in your fund, and then we're hands off. We're not part of the investment committee process. We're just sitting on the advisory committee looking at what you're doing. So it's quite of a strong commitment for us. We'll be there for 10, 15 years. So would be looking at certain number of safety nets in case things do not go according to expectation. We do hope that things will go according to expectation. In case that there is a derailing of the train, then there are some measures that are put in place so that we have certain protections of our commitment in your fund. Priscilla, over to you.
Yep. Thank you, Patrick. I just come back to this. Thank you also for the introduction. I would like to come back to the previous slide for 1 second. I think the timer is here, so I'll just go back on the first one, the target fund size. There are a few points linked to this. So meaning on one hand, the origination strategy, will you be able to actually deploy the fund? And on the other hand, the fundraising strategy. So yes, we want to be cornerstone investor in the fund. And we also know that the fundraising environment is very challenging at the moment. So it's important on one hand, we hope it's helpful for you to have us on board, while at the same time, we need you to also talk to other investors, bring them on board, because the mission of EIF is to help financing to European SMEs and small mid-caps by involving other players into this market segment. Just as a small comment on this. And now coming back to this slide, which Patrick introduced. And indeed, for us, it is a commitment of trust we give into the fund. So we want to make sure that at the end of time, the strategy that we discussed at due diligence is actually implemented, and there will be some clauses in the LPA, in the side letter, to to make it sure. And I think those who already engaged in legal negotiations with us, you are aware of what it means, what we are looking for. I mean, on one hand, we have the defined strategy. So, okay, what is the investment universe? Where are you going? Like on the private debt side, we would see concentration limits usually. The aim is basically to avoid a strategy drift over the life of the fund. Then if you have an ESG or impact fund, this would also be linked to the legal documentation with specific objectives and how to assess them. Then on the alignment of interest, as mentioned previously, we like to see an alignment of interest, and this should also be documented in the legal documentation. It can be a carried interest or performance fee, depending on the asset class you're in and what is more common. Then, there are some clauses with respect to conflict of interest management. I won't go into detail on those, especially in the interest of time. And the same applies to the removal to the protective clauses. So the idea is to protect other investors or that also invest into the fund, to basically provide best market practice. And the main clauses would be the removal clause, the key person clause, to ensure that there's always enough competent persons working on the fund strategy in order to deploy it in a qualitative way. And then another one would be the defaulting LP clauses. Now we have a quick look at the ESG assessment, which is indeed at the core of the EIF's processes. And we look at 6 steps in this process. One is and we usually look at the level of the GP, what do you do? And then also, what is the assessment you do at the level of the underlying companies, of the underlying investments that you carry out? And it obviously depends on what you are marketing, what kind of fund you want to be. If we talk about an SFDR Article 8, which incorporates ESG, or if you look at an SFDR Article 9, which goes more into sustainable investment, we will obviously look into this more in detail, also in view of the strategy you are implementing. And I quickly go through the points mentioned here. We have the policies and the governance structure. What policies do you have in place? What do you look for investee companies to have in place? Ownership and stewardship. What indicators you look at, how do you engage with the companies? There are definitely strategies where this is easier than in others. Let's say, for example, on the private debt side, it can be sometimes more challenges as you do not have a direct seat on the board. However, we also know there's a way that can be influenced in each strategy that is carried out. We do the pre-investment screen. Then another important one is the reporting point. On one hand, to LPs, but then also at the level of the company, what is reported, transparency on this topic, and compliance with EIF's ESG principles. And I left the 2 points at the top, which also marked in a different color, which are the ones where we put a bit more hard blood into it, if I can say it in that way. So on one hand, the diversity and inclusion, which is also the purpose of this workshop today, and I think we have talked about it a lot. But it's also part of what is assessed in the context of this ESG DDQ, and finally climate change and climate change mitigation. And so, what is it you are doing? We're on a long way. We know, as we have done it in the past, will not bring us towards the future. There needs to be changes carried out, and we want to understand to what degree do you take them into account in your investment process, and to what degree do you actively try to improve on this level. And with this, I would quickly hand it over to Patric, who will give the final details.
Thanks, Priscilla. I know you're all getting hungry or getting towards lunchtime, but there are only 2 slides left, maybe only 1. So a couple of tips for you in the room who are thinking about setting up their fund. The first one is be patient. It takes a lot of time with the EIF. The process is 9 to 12 months, rather 12 months. So by the time the clock starts ticking when You have sent us your pitch deck. Until the time we are ready to commit in your fund, it takes 9 to 12 months. Well, the reason is that, as we said and as we explained, we are here to support your fund, but we are looking not only at the fund that you have presented to us, your fund number 1, but we want to make sure that you have already integrated the infrastructure for being able to raise a fund 2, a fund 3, a fund 4. So each time you approach EIF, we look at you as a potential future blue chip fund manager in Europe. So that's why we take a lot of time in assessing your proposal. Tips to you. Don't start with the strategy. I've started my presentation by saying that our focus is on the strategy. I think you, as fund managers, or future fund managers, should start with who you are. What is your DNA? What have you done? What type of companies have you invested in? What is your field of expertise? That should be your starting point. And once you have better define that, once you have a better idea of who you are, you assess what the market is and what is the market demand, what is the stage of development, what are the requests and the expectations of the entrepreneurs of the market that you're familiar with. And once you have understood what you have to give and what the market is looking for, then you define your investment strategy. And once you have defined your strategy, then you bring around the other pillars, the fund parameters, your target fund size, the management fee, etc. That's all, I would say, secondary in a certain way compared to the strategy that you will be putting forward. But as an established fund manager, of course, we're not expecting you to come with always the same investment proposal for Fund 1, Fund 2, Fund 3, Fund 4, Fund 5. That would be a bit boring and most probably dangerous, because you have to adapt to the changing market reality. And we know that this changes faster and faster, so you have to integrate all the time new ways, new parameters, new market constraints. What we really do not like when we discuss with established fund manager is that when they talk about their past performance and sometimes their negative past performance, they say, well, sorry, that's not our fault, it's because of the market, stupid. Well, yes, but we are entrusting those fund managers with money. We're expecting them to invest those monies in good time and in bad time. And we're expecting the fund manager to integrate the fact that there will be crises. We have a crisis now. We have the pandemic crisis a couple of 3 years ago. We had a financial crisis in 2007. A crisis will pop up during the lifetime of your fund, so you better integrate that. And be open to the feedback of LPs who have also a share of experience like us. Be open-minded, but take responsibility for your past successes and your past failures as well. And that was the last slide about opening the black box of EIF. It was fast. I'm sure you have hundreds of questions that you would like us to address, but that's why we have these breakout sessions now during the lunchtime. Don't hesitate to come and ask any question. Please don't shy away of any question. There is no good questions or bad questions. We're not taking the names of who is asking which question and keeping that into our files. So this is your occasion to ask any questions you might have to the team of EIF. Thank you very much for your attention.
Thank you so much, Patric, Cindy, and Priscilla. Actually, we're going to get an extra 10 minutes for some questions and answers from you guys right now. So we'll definitely open the black box. I hope it's not a Pandora box right now, but probably it is. And remember, don't hide your failures. Patric and his team will definitely and eventually learn about it. So yes, I mean, all that being said, who has a question? So we can definitely get questions from the audience in here in Luxembourg, or, you know, if you're actually following us live on the streaming platform, you can definitely post your question on the Q&A chat box, and I'll be happy to be your spokesperson on this very stage. I'm actually getting a lot of questions on, can we find slides back after the event? Can we actually have more than slides, but also the portfolio models posted? Yes, this will be available right after this networking event, Empowering Equity, here today in Luxembourg. So, do we have any question here from the audience? We do.
So talking about failures, what are the few things that you consider a huge failure that would be an instant no?
A huge failure. That's quite of a wide question. A fund manager who has repeatedly failed to deliver the expected returns to a fund manager. We will be, of course, much more demanding towards a fund manager who is raising a fund number 4, number 5, number 6. If you realize that fund number 1 is a failure, fund number 2 is a failure, fund number 3 is a failure, I would say then it's going to be very difficult to convince us that the fund manager will deliver a positive future performance. So I think it's rather the success, the accumulation of failures over several generations of funds that I would call a big failure. Sometimes it happens that the first fund or the second fund has not performed according to expectation. We will assess that, provided that the fund manager, as I said earlier, takes his responsibility, partial responsibility for the failure. We are ready to take that into consideration. But the systematic failure over several generations of funds and fund managers saying, well, sorry, it's not my fault, it's because of the market, that would be quite of a no-go for us.
Yeah, I think on the private debt side, what we can say as a failure, what we look at is default in the past and how they have been dealt with. And of course, it depends on the market environment, and we do indeed take this into account. But yeah, we would need to understand what expertise do you have and how can you turn that around? What recoveries have you obtained? Yeah.
Another one, failing to, what I said earlier, failing to understand that you're a portfolio manager and not a serial investor in a series of companies. That was really an issue on the venture capital market in Europe. Most of the fund managers 15 years ago were not willing to take the risk of exposing 15% of their fund to the one or two winners that they had in the portfolio. So having potential success stories that the fund manager are not able to leverage into a return to the LPs, that we consider that as a portfolio management failure. Luckily nowadays the market has matured. All of the fund managers have integrated this importance of leveraging, maximizing the exposure to the success stories. We would consider that as a potential problematic if the fund manager doesn't understand this concept of and this absolute necessity of managing a portfolio and not just a collection of individual companies.
Any other failure examples, Cindy, on the private equity side?
So on top of what Patrick just said, I would say keeping the team together, that could be a failure as well. If there are too many people leaving the team, if we see that there's no cohesion, that could be a failure. Reputation in the market, if we go to portfolio companies and they tell us, yes, this guy is super aggressive, he's on my back every day, I can't do my job. That would be badly perceived. This kind of, he does not provide any added value. All of this would be considered a failure.
No, it's a super important point. You're absolutely right to raise that one. We have an example again in the portfolio, which is telling. We have invested in a fund manager a couple of years ago, and we are discovering now that one of the partners was in a court case at the time we were on due diligence. The team knew about that. They haven't disclosed that to us during the due diligence process. We're committed in the fund now, and we feel that the fund manager is not being fully transparent towards us. This partner now has been convicted, he's guilty, and still we don't get a full picture of the situation. So failing to be transparent towards your investor and telling about what exactly is going on in your partnership with your partners, that's a big failure, honestly. Then trust is breached, and to rebuild the trust, it's going to be a difficult, very difficult journey. So a very important point indeed. That's
definitely what I call a big failure for some reason. But yeah, so sharing's caring. So Just be, like true to yourself, honest, and share the information. We do have 2 questions from the floor. Let me just take one question from the streaming, and then I'll get back to you in a second. We have this one question from our audience, like literally joining us live on the streaming app. Would you support fund managers, first-time team, first-time fund that come from the social finance sector?
Yeah, why not? Yes.
Yes,
actually, well, what we have seen on the social impact, we started that practice in 2012. Thank you. In 2012, the first fund managers that came to us, some of the first fund managers were coming rather from the philanthropic world. Our approach, and now we're getting specific on impact and social impact, is that we do see a positive correlation between social impact and financial returns. And the first funds we were getting from a philanthropic basis, we were actually the one who had to convince those fund managers that they could generate financial performance while also investing into a social impact company. So yeah, why not? Absolutely. Nowadays the market has matured. That was in 2012, 10 years ago.
Back to question from the floor. We have 2 questions on this very side. First in here.
Hello, Annegien Blokpol. I'm a Catalyst investor, and I saw you are having Catalyst investment as one of your main objectives. There's going to be a lot of capital going into this, and a lot will be going to women, and women invest completely different than men, which means you're setting up a completely new ecosystem. And in 5 years' time, where do you think we will be? What we will have achieved, especially looking at your 2 main objectives. And so I think it will help us all, because we fit into that framework, which is not the old framework. We're collectively actually co-developing a new framework. So in 5 years' time, we look back, what have we achieved?
Yeah, very good question. So we are a fund investor, so we're not investing in directly into companies. So when we were discussing with Astrid and her team and the European Commission, we were questioning ourselves whether we should improve gender balance at the fund manager level, intermediary level, or have a requirement at the underlying companies level. Eventually, at this stage, we have decided to improve the gender balance at the fund manager level, the intermediary levels, but that's not the ultimate goal. We're doing that because the feedback from the market and the feedback from you and the fund managers is that fund managers tend to mirror themselves when they're investing into companies. So the more female partners, the more female GPs we will have in the VC community that's the objective, should have a significant impact on the diversity of the entrepreneurs which are targeting by the VC funds. So ultimately the goal is that when we'll be looking at the composition and the gender diversification of the entrepreneurs community, that we have a more inclusive and a better balance between male and female founders. That's the ultimate goal, and hopefully we'll get there in 5 years' time, but it's a long-term game, right? We're investing into funds which are starting investing now, and they will be investing it for the next 5 years and 10 years' time. So, but that's the long-term ultimate goal, I would say. Astrid, please, as a commission representative, tell us if I got it wrong.
I think you made an important point. It's really this question of changing a mindset. Where do we want to be in 5 years? How will we influence the market? Because we are indeed a fund-of-fund investor, and that's an important point. We will not go and decide on each investment that is taken, but by the way of investing into certain funds or into other funds we do maybe not invest, we do set or hope to set a signal for the market reflecting these these policy objectives, and then to also shape the market and attract private investors into these areas.
Yeah. Do you need a mic, Elodie?
Personal point, I think here is about gender, but to me diversity is just way beyond gender. So 5 years from now, how about handicapped focused strategy, underrepresented founder? There's so much we can do. We're starting here today, but in 5 years' time, I really hope that we'll see a lot more diversity than just gender.
Diversity and inclusion starts now. Let's get one final answer for now, and then I'll release you for a networking lunch, so you'll have plenty more time for questions.
Thanks a lot, and thanks for the excellent presentation. I had a question on the investment strategy. How many strategies have you seen with a strong gender lens embedded in the strategy? And how have you evaluated those? I'm thinking of, are there investment strategies that really are saying, let's actually, take the opportunity of building a world designed for women as well, not just for men?
Yeah, I can maybe answer on the private equity side. So we've got 3 fund managers currently having such a strategy. One of them is present in this room. So it's still very early. We don't see a lot of team pursuing this strategy, but clearly this will be one that is of great interest for us.
And Patric, if you want to dive in.
Same answer. We haven't seen that many yet. And we're looking forward at seeing more proposals at aiming at improving the gender balance. Unfortunately, we do not have a dedicated pocket of money for that specific strategy. So this is a call for our shareholders and mandators. There is a market here that we are ready to support. And because we don't have that specific mandates, the proposal that we're getting from this type of strategies are in competition with our other verticals, which are all equally important. As you know, we have a mandate for climate action. We've talked about it for space, for blue economy, for many other sectors. So there is quite of an intense competition for between the proposals that we're getting. But we're looking at doing more and also partnering with our main mandators and shareholders to bring further financing for this type of strategies.
Thank you so much for your incredible and outstanding questions here in this room. Thank you so much for the many questions I'm actually getting now from the online stream. They will definitely be answered later on, but you will definitely get an answer again.